Hello and welcome to this video on patterns of trade. So in this video we're going to look at what we mean by patterns of trade and look at some important recent trends in global trade. So when we're considering the patterns of trade, we can really talk about two different things. We can talk about the geographical trade between two countries. So looking at the countries with whom a nation trades, or looking at trade between countries within particular regions. We can also look at trade in terms of what countries trade. So we can look at the types of products that are traded internationally. Are these primary sector products, manufactured products, or maybe dominated more by service sector exports? Typically, countries at an earlier stage of their economic development tend to export a narrow range of products, and they often tend to focus more on primary sector products like commodities, and we call that often primary product dependency. So this is why trade has become so important. If we take a step back and look over the economic history of the last 200 years or so, we can see that really up until globalization kicks off in the late 1970s, we don't have a great deal of trade between countries in this previous period. However, throughout the 90s and the noughties, as the world becomes increasingly globalized, one of the key characteristics is this huge surge in global trade and the interconnectedness of economies. A nice way to illustrate this is to look at this image where each little yellow dot represents a cargo ship. And so we can see a lot of the main trade routes from places like Japan and China coming down through Africa up through the Suez Canal and into the Western European markets in Europe. We can also see quite significant trans-Pacific trade routes here with these lights as well, and some cargo going up the west coast of Africa. So again, it shows us quite nicely, it illustrates the interconnectedness of countries. This is another graphic that shows us the changing patterns in trade. And it can be quite complicated here, but effectively what we have here on the left is we have the position in 1992, and on the right we have the position in 2014. So 1992 on the left, 2014 on the right. The circles represent what's happening with global trade. So here we can see global trade coming from developed Europe. So these are exports coming from Europe, and we can see that exports from Europe account for 5% of European GDP. We can then see relatively small amounts of exports coming from the developing countries in Europe, so Eastern European countries predominantly, and we're developing Asian countries as well. And then again, some smaller contributions from other countries. If we fast forward to 2014, what do we note? Well, in particular, this big chunk here of exports coming from developing Asian countries. So a big expansion of exports since 1992 from these countries. We can see developing Europe as well has also increased its scale of exporting, as well as developed Asian and Pacific countries. Increasingly we see, while still a lot of imports from North America and Europe, the rate of increase has been faster from other areas. So to summarize the key points from what we've seen so far, emerging economies, particularly those in Southeast Asia, account for an increasingly significant proportion of trade. And by that we're talking about the BRIC countries and the mints that we'll come on to. Over half of all exports now are from developing countries. Export destinations are still dominated though by developed countries. Increased trade between developing countries is occurring, so more developing countries are trading with each other, although it's still not at the level of trade between developed countries. The moral of the story, really, what we're seeing in terms of changing patterns of trade is that developed countries still dominate trade, but there is a convergence over time where developing countries take an increasingly active part in global trade. So these are key points, and we need to make sure we have them down in our notes. Now let's go on and look at about types of products. So if we talk about merchandise, we're talking about kind of basic electronics and clothing and stuff like that. Where are the main exporters of these? Well, the top one is China, followed by United States, Germany, Japan, and the UK. So here we can see on the right-hand side in 2015 where most merchandise exports come from. We've got the European Union, and then China, USA, Japan, South Korea. The biggest exporters of clothing in the world, well here China dominates, then we have EU, Bangladesh, and you might notice that a number of these countries are fairly low cost. Now we mentioned earlier the BRICS countries, and they take an increasingly important role in international trade. And the BRICS stand for Brazil, Russia, India, China, and South Africa. So this statistic here shows us quite a lot. At the bottom here we have this idea of the full circle, representing 100% of the world. So in terms of population, the BRICS countries account for nearly half the world's population, over a quarter of the world's area, and nearly a quarter of all the world's exporting and importing is done by these countries. They account also for not quite a quarter of world GDP. So these countries are very important, very significant, and their emergence into the global economy over the last 20 years has been a significant change. Perhaps some of the fastest rates of growth now are seen by what's known as the MINT countries, and that stands for Mexico, Indonesia, Nigeria, and Turkey. Again, we can see significant populations, so large labour forces, and increasingly playing a large role in international trade. Now let's go on and look at some types of exports. So we're going to start with a developing country here, Malawi. And this infographic shows us what Malawi exports. And we can see that things like tobacco, tea, sugar, dried legumes, it's very much primary sector orientated. So we see often a lot of developing countries' exports are mainly primary sector. Whereas their imports, they still need to consume many of the normal things that are consumed. Things like cars, we have electronical equipment, we have chemicals. So a problem here for Malawi will be that they're importing things that are typically more expensive than the value of their imports. If we look at somewhere like the UK and look at their exports, we see much more of a variety of exports. We see some mechanical equipment, we see cars, we can see some primary products, but we can also see things like medications and a lot more variety in terms of their their portfolio of exported goods. Remember also that the UK exports a lot of services as well. When we look at the imported goods into the UK, again we can see quite a wide variety, lots and lots of different items, but again we see some energy, cars, computers, and so on. So there's a high level here, what we might call intra-industry trade. It tends to import similar products from those that it exports. So the UK is quite a sophisticated economy with quite a strongly diversified pattern of trade. If we look, for example, at somewhere like China, we can see that they have quite a strong performance in terms of machinery, textiles, and things like basic chemical products and clothing. If we look at somewhere like Bangladesh, then we have a very specialized economy here as a real comparative advantage in the production of textiles. So in this video, we've looked at what we mean by patterns of trade. We've looked at some issues with geographical patterns of trade. We've also looked at some issues in terms of the nature of the products that are being exported typically from different types of economy. That's it. Thanks very much for listening.